So without further delay, we will go ahead and, good morning. And Mr. Ranjan, very warm welcome to you. And probably Rajesh Bhatia will chip in. Today, the products, once upon a time, until few months ago, these kind of products, SIF, specialized investment, these kind of products were available only to the HNIs, high net worth individuals. So more than 1 crore one has to invest. So what is so special about these products? Generally the thing is, investors always want to have a decent return, decent income. At the same time, they don't want to lose money. So generally, we used to say the retail investors, no, you can't, eat, you can't have the best of both worlds. So there will be some pain at points of time. So when market goes down, your investment will also go down. So you have to accept that fact. And when market goes up, automatically your overall Rajesh has joined, I think.
Rajesh has, yes. Mr. Bhatia has joined.
Rajesh, you can unmute. Mute yourself, Rajesh.
Yeah. I hope you can hear me now.
Yeah, and can you on your camera?
My camera is on.
Okay, just.
Are you unable to see me?
Yes.
Yeah, yes. We are unable to see, basically, but
nevertheless, probably.
Is this better? No, I'm able to see my camera.
Yeah. Now it's okay. Now I am able to see you, Rajesh.
Okay. My apologies. This took a little longer because I'm at a network area probably which is not great. So my apologies for this.
No issues, Rajesh. And I'm glad that you are able to join. I'm very happy. Probably it is for me as well. From next time, CIO, CEO, whoever, I will test it one day before.
Yeah. Makes sense.
Yeah.
So my apologies to everybody who's joined that I took a little longer.
No
problem. Yeah. So nowadays, fund houses are coming out, one by one with these specialized investment funds.
Right.
Currently, ITI Mutual Fund is launching their SIF product under Divinity brand. And, ITI Mutual Fund,
Correct.
one of the co-founders of ITI Mutual Fund is also a co-founder in the Sun Pharmaceuticals. Let me just put everyone in mute, and then Rajesh, when you speak, please unmute yourself. So there is some, since this is in meeting mode, someone some people have not muted that thing. So I have muted it, and whenever Rajesh, when you speak, please unmute it. Let me introduce you first. So, and ITI Mutual Fund, is co-founders of Sun Pharmaceuticals, one of the largest, pharmaceutical company in India. ITI, they are into finance for quite some time, and they launched their mutual fund 5-6 years ago, and now they are managing more than 10,000 crores. And today we have Rajesh Bhatia, who is the CIO of ITI Mutual Fund with us. What is special about him? He is one of the very few people in the industry who has experience in equity long short category, particularly. So already ITI is managing long short funds in their alternative. So it is not that even some of the major fund houses do not have experience in long short, because those are long only. So this is a great thing to have. Rajesh Bhatia is one of the person well known in the industry for his long short experience. Anyway, and Bhatia has 30 years of experience, more than 30 years of experience in Indian equities, and 10 years in the field of alternative investments, which is long short management, long short fund management. He has worked as the CIO of Sinto Investment, a subsidiary of Tata Investment. He was a co-founder and CIO in Heritage India Advisors, Indian advisor to New York-based Heritage Capital. Then he has worked with the PMS, Reliance Capital Asset Management, and others. He's basically a commerce graduate with the CFA and the ACMA. Welcome, Rajesh, to our channel. Thanks for accepting our invitation to share your knowledge with our subscribers this morning.
Thank you. Thank you so much, sir. Thank you for having me. Ranjan, sir, it's good to connect. Ranjan, sir, do we have the presentation of the SIF?
I do have. I can share it. Just a minute.
Sir is there. Presentation is there with sir, and sir will run that also.
Excellent. So great. Very nice to connect with all of you. My apologies. There was some, I'm a bit of a technologically challenged person, so there was some time that I took to kind of connect. So, I think the subject of SIF, basically SIF is a new format that SEBI has introduced for sophisticated investors. The type of products that you can get in the SIF is very similar to mutual funds. In mutual funds, you get equity products, you get fixed income products, and you get hybrid products. The same under the SIF umbrella, you get these variants of products. So SIF is not one category, one product. There are different products. SIF is like an umbrella under which you have various products. So you can't compare one SIF with another. You have to actually know what the objective of the fund is, whether it's an equity-oriented product, fixed income product, or a hybrid product. So that's the first categorization that I think people will have to keep in mind when they're evaluating various SIF products. The key distinction that the SEBI has done in regards to SIF is twofold. One is that the minimum amount is 10 lakhs. So it's only sophisticated investors who can actually become part of the SIF. The other is that they have allowed naked shorts. Earlier, even in a balanced advantage fund or arbitrage fund, you can hedge, but you cannot do a naked short. What I mean by naked short is, let us say you don't own HDFC Bank. Then you cannot short HDFC Bank. Short meaning sell first before you buy again. But in the case of SIFs, the SEBI has allowed you to short as well up to the extent of 25% of net asset value. So those are the two distinct features. But otherwise, SIF is also under the umbrella of the mutual fund, and SIF also offers distinct products, just like a mutual fund, equity-oriented, fixed income, or hybrid. Okay, where are we? We are focused a lot more on the equity long-short product, right? So that is where our product introduction is. So I will focus my conversation today on the equity long-short product only, where, as sir pointed out, that we have a fairly long history. I personally have been a long-short equity manager for 18 years. It's possible that we are among the most experienced long-short manager in the country. For 7.5 years at ITI, we have been running a long-short fund. Again, that is one of the longest track records for an equity long-short product. And
Rajesh, sorry to interrupt you. If I may ask you, in your long-short fund, how much approximately you manage?
Yeah, we manage about 1,000 crores in the SIF format. And we've been doing it for 7.5 years. And if you ask Grok or ChatGPT, they will say that the most consistent long-short product is ITI. So you don't have to ask me, you have to ask Grok or ChatGPT, and they will tell you, if you put in which is the most consistent long-short product in the country, the answer will be ITI long-short is the most consistent. So we have done it for a long time. And, I like to say that, we have done tapasya for 7.5 years in the long-short format. And SEBI has given a vardhan that, because you have done tapasya in the long-short, that you are entitled to now get a SIF, format where you can actually democratize what you have achieved for high net worth individuals in the long-short format. Go ahead, sir.
Sorry to Rajesh, interrupt you. A few things I have, which are more, baby questions for you, but it is important for our investors, to choose these funds or why should they go for these funds. Some of the basic questions, then I will let you explain the system, how you do it, etc. Or along the way answering if you want. I hope the presentation is visible.
It's visible to me, yes.
Yeah, okay. So along the way, you can tell me the slides, I can rotate, and accordingly you can explain.
Yeah.
So
yeah.
Today, why investors, a mutual fund investor, or which investor should go for this SIF, specialized investment fund?
Okay. So can you roll down the presentation? If you roll down the presentation, more. One more. Sorry. Yeah. So what is the purpose? To answer your question, what is the purpose of a long short equity fund, right? Why should I even bother? See, the purpose of the long short fund is really, according to us, asymmetric return profile. At least that of a long short equity fund, which is where we are. What is the asymmetric return profile? Basically, you want to participate on the upside of the market, but you don't want to participate on the downside of the market. That chart in front of you will tell you what that asymmetric return profile. If you can see from Jan 23 to September 24, let us say the market went up about 42%, right? So the long short equity fund went up about 44%. Subsequently, the market went down by 14%, and mid cap and small cap actually were down 20 to 25%. We were down 3. And what is the cumulative effect of that? If you can see the lowest bar there, the lowest table, you will notice that over the full period from Jan 23 to March 25, market has gone up 22%. The long short equity product has gone up close to 40%. You have generated 18 percentage points of alpha with far lower risk and far lower volatility, right? So that's the objective of the long short fund. Participate in an equity upcycle, but don't participate on the downside, right? Now, so let me just clarify again. This is an equity product. This is a long-term capital appreciation product, not an income product, right? And the purpose of a long short equity fund is to protect downside in your cycle. So what it does is it adds value to your portfolio. So, you know, that it is uncorrelated to your portfolio, that if God forbid, if the market goes down, this product actually protects your capital. But if the market goes up, it is still giving you equity return. So it gives you diversification to your portfolio and minimizes the risk in your portfolio. If you go to the next chart, sir.
Yeah. In a layman's term, if I may ask you, say like if market goes down, just an example, arbitrary number, if the market goes 20%,
yeah.
Now the mutual fund equity, all the equity mutual funds will go down by 20%, 20 or more.
Yeah.
So because they are only long only products. But how much will be the effect in your, in the to be launched or in general long short funds, SIF?
So what, to answer that question, if you can see the chart in front of you, that is the 7.5-year track record of a long short fund, right? And the bubbles that you see, the round bubbles that you see, that is the time that each of the time when the market has declined. It answers your question that God forbid if the market falls, how much does a long short equity fund, how much has it fallen? Now the most conspicuous part of that is the COVID period. February, March 2020, top to bottom, actually market went down about 38%, right? This long short fund actually went up. So you can see over a 7.5-year period, you're protecting your capital. By the way, you're beating the market and you're compounding at between 14 to 15%. So you're making 14 to 15%, but your capital is protected. And this is an extremely liquid strategy. The NAV or the subscription and redemption is happening daily. So you're getting a liquid product where you can protect your capital, but you over a period of time, you are making equity beating return, right? So we have done this for a very long time, right? And we have a fantastic, consistent history of achieving it. Sorry, you were asking a question?
Yeah, one more question is, say, like whatever you are already doing for the last 7.5 years or 10 years, there I think you do not have any limitation for short covering or naked shots, whatever, all those things you are free. If I am right, I really don't know. So whereas in this case, SEBI is allowing you to only up to 25% the derivatives, they're going short or whatever. Am I right?
Yeah. So you're absolutely right in terms of theoretical ranges. So in the AIF, the exposure can be 200%, which means if my NAV is 100 rupees, I can take exposure up to 200 rupees. Second, there is no constraint in terms of shorting. I can be short 25%, 35%, 45%, 100%. There is no constraint in the AIF on the shorting side. If you come to the SIF can 100 rupees means only 100 rupees can be invested. There can be no leverage in the SIF. And the second part is you can only short up to a maximum of 25 rupees. You cannot short 50 or 100 rupees. Having said that, in our AIF, we have 80% of the time been less than 100. So replicating, and only 20% of the time we've been at 120 or lower. So what we have done in the AIF is easily replicable in the SIF as far as exposure is concerned. Second, I can short any amount I want in the AIF, but I can short only 25% in the SIF. But I have not shorted more than 25-30% ever on single stock futures. Right? Remember, in the SIF, I can hedge also and short. Hedge means, let us say, if I have HDFC Bank long, I can short the exact amount of HDFC Bank like an arbitrage fund and cover my position. Over and above that, I can do naked short. So the fact is, even in the AIF, I have never gone short more than 25-30% because if the market goes down dramatically, let us say we are in the COVID period, market goes down. What do? I don't only short, I just reduce my exposure. Because I reduce my exposure, my need for shorting is much, much lower. So to that extent, to answer your question, sir, in simple terms, what we have done in the AIF is easily replicable in the SIF format also.
Okay. And I think if I'm right, you are the second fund house in the country to launch this equity long short product, whereas others have gone with more of hybrid nature. Of course, others may not also have expertise, but you do have expertise. Is there any particular reason to launch this fund at this point of time?
So you answered the question, sir. Basically, that we have a skill set of a very long period, and we think that offering this to mutual fund investors with a 10 lakh rupee ticket size, it gives them an opportunity to participate in a product like this, which is of very good value add. See, I'll tell you, sir, the need for a long short equity fund has never been greater. Why do I say that? See, this product, what does it do? Participate on the upside and protect your capital on the downside. Now, if you listen to several smart investors, right? There is one fund manager who has been saying that retail people are all taking all the risk, right? Right. So if you listen to all smart investors, a lot of them are saying Indian markets are a little overvalued. That even if I compound from here, I will not make more than 11 to 12% per annum, right? So because the valuations are very, very elevated. At the same time, a lot of sophisticated investors are extremely worried about the geopolitics, the global multipolar world, the fact that France and UK can go to the IMF and default. It's become a very, very fragile world. Several wars going on. So people feel that the risk and the volatility and the fragility in the world has just gone up. And here I am paying very, very elevated valuations. So I need a margin of safety. 11-12% is if the market just keeps going from here. If it comes down and then goes up, that 11-12% can be lower. So people are worried that my compounding is going to be low. So I need some diversification of my portfolio. So if I take, let's say, 20 rupees or 30 rupees from my portfolio and invest in a long short equity fund, then it gives me the required diversification, which means, God forbid, if the market goes down, my capital is protected, right? Or my downside is protected. And God willing, if the market continues to go up, I'm still getting an equity upside. So for that insurance that I'm getting in my portfolio, it's not as if I'm getting 3% or 4%. I'm getting an insurance, but it's still a healthy return that I can get. So the need for a long short fund has just gone up dramatically. So it's a very good offering at this moment also, because the need in a portfolio has increased. And who better? I mean, we have done this for 18 years. We have the skill sets.
If at all you have to compare this fund, this equity long short fund in SIF with any of the mutual fund category, what would you say that okay, this might come closer to this return wise?
So basically, some people will say, look, if you have an opportunity to invest in a long short equity fund, I want to ask you the question: why will you invest in long term debt? Why will you invest in private credit, which is illiquid? Why will you invest in an arbitrage fund? I've shown you the risk return. Please, in your mental mind, when you're looking at these products, look at the risk return I'm talking about. Why will you invest in an arbitrage fund? Why will you invest in a large cap fund? Why will you invest in an equity saving fund? Why will you invest in an ETF? Why will you invest to some extent in a balanced advantage fund? So this risk return is better than all of these products that I just mentioned, right? So if executed well, this product has a fantastic risk return profile. And the taxation on this is equity taxation.
Yes.
So from a risk return perspective, this is a very disruptive product according to me. And like I said, the need for a product like this has gone up. Okay, some people say, because in just mental comparison, how does it compare with balanced advantage fund? Now, in balanced advantage fund, what typically people do is that they believe that they are an asset allocator. So when equities are expensive, they will increase the amount of fixed income in your portfolio. But it doesn't mean that the equity will go to zero. And when equities are cheap, they will increase the equity in your portfolio. So, but let's say they'll take it to 60, 65, maybe even 70. But they will not take it to 90. But
yes.
whereas, so even in our COVID period, if you look at balanced advantage funds, they fell 25%. There were balanced advantage funds which fell 28%, 24%. That did not protect your capital, right? Whereas this product it doesn't take a hybrid kind of an allocation call. It is an equity product which can guard your capital. It tries to protect your downside as much as possible. I'm not saying it's a capital protected product, because you can see that we have been minus as well in those months when the markets have gone down, but it is definitely a very good downside protection product.
Yeah. Now, what gives me kind of confidence of this thing is with ITI, so like you have done this, whereas even the largest fund houses have not experienced this or done this earlier, because most of the fund managers in the industry are long-only fund managers. They buy, they sit, and it grows. I mean, it will give you good returns over a period of time, no doubt about it. But for these kind of products, it's better to give the money to a person who has already done this, experienced this, and give more confidence to the public. That's why probably I thought of taking you on this call, Rajesh. And
no, you have hit a nail on the head, sir. I will tell you, if you have any familiarity, if you guys, all of the people who are listening on the call, with people who have launched long short equity funds in the AI format, it is a graveyard. A lot of firms have closed down managing long short equity funds. So doing this consistently is a very high skill set. So anytime you are evaluating an equity long short product, please ask the fund manager, what is your number of years of experience? What is the execution that you have done? And what is the consistency of your track record? So I can be a long short manager for 10 years, but if I have no consistent track record, Do you want to be part of that fund? If I don't have the skill set, then I'm experimenting on your money. I'm learning the long short business on your money, right? So basically, the questions you have to ask anybody who is in the long short business, equity long short, sir, what is your track record? How many years have you done it? And with what consistency? So it's a very skilled product. That's why it's very difficult to do. That's why there is a graveyard of AIF players in the equity long short space.
Correct. True. I agree. And generally, most of our investors ask, what is my minimum holding period? What should be my minimum holding period in this equity long short fund? So how long should they stay invested to get good experience?
Yeah. So how long should you be in an equity product? This is an equity product.
5 years, we say, for long only.
So this is an equity product. This is a capital appreciation product. This is a product which has a different risk return profile to your entire portfolio. The need for a product like this has just gone up, right? So if I protect your capital and make you an equity return, why would you want a different product? If you can go to the next slide, there are 2 slides I want to just enumerate in terms of concept. Because this is, of course, the risk return profile. Look at the risk that you're taking to make an equity return. But yeah, so the risk numbers are there. The beta is extremely low and the Sharpe ratio is reasonably high, right?
Yes.
Please go one more, slide lower. Yeah. Next 2 slides, I want to just enumerate the concept. Yeah, if you can go to the slide above, sir. One slide above. Yeah, this one. If you can remain there. No. Yeah, this one. So I want to explain to you this concept, which a lot of people don't probably appreciate, right? So we all look up to Warren Buffett, right? But do you know what his first principle is? Rule number 1, don't lose money. Rule number 2, never forget rule number 1. Do you know today Warren Buffett is sitting on $380 billion of cash?
Yeah.
In a market which is one of the best markets in the world. There is an AI bubble going on. Stocks are going up double. But he's not investing. Why is he not investing? Because he never wants to destroy permanent capital. Right? Now, so if you look at, as Sir Clement says, if you can compound at 50 for 30 years at 15% per annum. In the 31st year, if you lose permanent capital, let's say you invested in Nvidia at $5 trillion valuation, and it goes to $2.5 trillion. Can it go to $2.5 trillion? Why can't it not? It was there 6 months ago. So you permanently lose capital. Your 31-year compounding becomes 7% per annum. You have destroyed 30 years of compounding when you lose money permanently. So any sophisticated...
From 15% it halved, huh?
It halves because, on the 31st year, you lose money permanently. Your compounding is gone for a long term. For the long term, it's gone. That's why Warren Buffett is sitting on $380 billion, but does not want to participate in a bubble. Because what happens in a bubble? Stock prices come down dramatically. And you lose permanent capital. Your 50, 60 years of track record of Warren Buffett can get destroyed if you want to invest at high valuation and lose money permanently. So there's an important concept. Rule number 1, don't lose money. Rule number 2, never forget rule number 1 for compounding of wealth over the long term. Now, which product can do that for you? Where you can, if God forbid, if there is a market decline, a long short product can assist you. Second point, portfolio 1, portfolio 2. Portfolio 1 is like a hare, rabbit. It moves very fast, but it's volatile, so it comes down also very fast. The second is like a tortoise, right? It moves adequately at a good speed. It's not a slow speed, it's good speed, but it doesn't come down that much. Surprise, surprise, the investing lesson is that the portfolio 2 is ahead. Why? Because it doesn't come down. That is what Warren Buffett is trying to say when you are trying to compound wealth over the long term. Don't lose money. So this is an important lesson. And what product kind of addresses this? The long short equity product. If you can go to the next slide, I want to just another concept I just want to enumerate.
This one is really fantastic.
Yes, absolutely. Now, people who are as old as me, remember, because when I talk to people, Indian markets will go down for 6 months and 12 months, and then after that, 15% per annum, right? People don't remember that 96 to 2003, the market gave a negative return. 2008 to 2015, actually, 7 years, it gave us zero return, right? Now, imagine if your customer or the investor is 50-year-old, 60-year-old, 70-year-old, and he's saying, let's say he's 50-year-old and he says, I have 5 crore rupees, I'm going to compound at 15% per annum. So by the time I'm 60, I'll have 20 crore rupees, enough for my requirement. What if that 5 crore remains 5 crores for 10 years later? Has it not happened before? Right? Can he afford flat returns for 10 years? Even worse, if he's 60. Some people have 80% of their savings in equity only. What I'm saying is, taking some money and putting that in the long short fund helps you to avoid such mistakes. So in Jan 2008, if you had given money to a long short manager and a long only manager, the long only manager 100 rupees became 25, right? And the long short manager just lost 1.5%. Next year he was up. For the long only manager, that 100 became 25, and to come back to 100 took Jan 2015. So, so basically, again, there is a merit, and which I think Indian investors don't understand or appreciate enough, that equity returns can be flat for a long period of time. So these two concepts, one, protecting downside is important. Second, ensuring that you have a product which can ensure a little bit of compounding is very necessary to your portfolio.
I agree, but one of the things we face with the retail investors is, how much I can get immediately. That is the question they ask: how much I can get, how much maximum I can get. But they don't want downside. At the same time, they want maximum returns. So probably, this long short SIF could suit that, because the downside is protected. And I'm again telling, it has to be given to a very technical fund manager who has done this, who has experienced this, because all the path is not glitter, all the glitters are not gold. So that way, that gives more of confidence, and for a period of time, as you explained, probably this can protect the wealth also for a period of time. And you are accepting SIPs, allowing SIPs, SWPs, everything in this fund as it is there. One of our, just in the chat box, I received a question saying that what is the difference between SIF and PMS?
No, PMS usually is long only strategy, which is PMS is and PMS is taxed at the individual level, so you don't have the benefit of mutual fund taxation. So PMS is usually a long only product only. PMS people don't do long short. So the fact that this ability to protect capital and that kind of a risk return is not available in PMS, it's a long only product.
Long only product. And there is a question which I can answer. What is the administrative charges? Probably, I think it is the expenses. That's what they are asking. It's somewhere I saw in the presentation. Anyway, we'll let you know. It should be around 2.5%, my guess.
Everything is all the investments, everything is in the mutual fund format itself. So it is a mutual fund, but the category is just called SIF. That's it.
Okay. And so it's more or less like a mutual fund expense ratio.
Absolutely.
Yeah. So it should be around 2.5% approximately.
So it is purely on the TER. That's why it has given TER. So just to add everyone, just to add one point, that as sir told that about the taxation, this is the biggest benefit, sir. In PMS, you get each tax, each transaction get taxed. Here it is, you are getting long-term LTCG, simple. So that is not available, which is the biggest beneficiary, sir. That is one thing. And even If you look at in AIF, derivative, wherever you take, it's a business income, correct? So here, business income can goes up to 39%, correct? Plus surcharge. So here, with 25% hedging also, SEBI has allowed to have a mutual fund taxation. So this is the biggest benefit. And also to tell everyone, every day NAV is there. In other product, you have monthly one NAV. This is everyday NAV. Post that you have SIP. And I would request that, Rajesh ji told also to me we were discussing one day that, Ranjan, after 2 years, you can think about SWP. Don't think SWP now. So SWP is possible. STP is also possible. So this product perfectly suit when someone has made some money, some wealth, and that wealth has to cater in the Nifty level or Nifty plus level kind of market participation, probably, if I'm not wrong.
Correct.
Okay. So, then there is, one person has asked, is it possible to share the presentation? Definitely, we will share the presentation, probably because when we upload this video, this conversation in YouTube, in the description box, I will give you the link so that you can download the presentation. It should not be a problem. And SIF allowed naked, is SIF allowed to have naked long?
Yeah. Of course, naked long is of course allowed.
Of course allowed. Okay. And 75% was in terms of 75% portfolio. How you manage it? Probably, I think you have given a slide. Let me. How do you manage it? The fund. That's what they are asking.
Yeah.
Is this the right slide?
This is one of the slides. You can also go lower. There's a portfolio construction slide. Lower. One more. Yeah, this is it. So if this is the constituents of the portfolio, so there is strategic equity, which is long-term equity, just like a long-only fund. Right? These are cash equity holdings. Let us say, you have companies like Bhatia, HDFC Bank. Those are your strategic cash equity long, right? Then there's something called hedge, just like an arbitrage fund. Let us say if I'm long HDFC Bank, 100 shares, I can be short 100 shares of HDFC Bank, and basically that's a perfect hedge. Then there's something called tactical long. So let us say, when the GST came, the automobile companies benefited from the GST the cuts, because that's a very sizable cuts to the prices of automobiles. So let's say you wanted to benefit from that trend. So you bought, let us say, Mahindra and Mahindra, but you bought it in the futures market. So that's a very tactical kind of a play, rather than a very long-term strategic equity cash holding kind of play. Then there's something called tactical short. So let us say you don't like a bank which is exposed to the microfinance industry, and you have shorted it in the hope that the price goes down, and then you'll cover it. So that's a tactical short. So you have cash equity, which is long term. Then you have hedges, right? Then you have tactical long, and then you have tactical short. The total of that is what is called the net exposure. What is the net exposure? It is the equity exposure that you have to the market. Sorry, can you hear me? I'm audible. Hello?
Yes, Rajesh.
Okay. Sorry, I just thought I lost you guys for a second. So the net equity exposure is nothing but strategic equity minus hedge plus tactical long minus tactical short. So if you add it up, that is the equity exposure that you have to the market. That equity exposure, the net exposure, the second last line, can go from minus 25, that's a theoretical way, which minus 25 means I'm actually net short the market, and it can be up to plus 95, which is basically I am 95% exposed to the equity market with an equity holding to the market. So that portfolio can range. So if the market is going down, let us say like COVID period, we can own 0%, 10%, 20% of equity, and therefore protect our downside. But God willing, if the market is going up, we can increase our equity percentage in the portfolio, and therefore improve the return profile of the portfolio. So that is the thing. The skill set is basically finding out great companies to invest in or go short on, and then to navigate the market with exposure limits. That is really what the objective and the.
Rajesh, ask you
Yes,
one question.
Mhm.
You know, I'm seeing, from minus 25% equity exposure to
Yeah, yeah.
plus 90% equity exposure. Okay.
Yes.
So, do you get sleep?
I sleep very well. So no, but you're right that it's a very intense product. Um, uh, you know, um, so basically that's required. But look, the markets very rarely just uh, with the unannounced decline very significantly. So every market decline has a logic or a thought process. No market declines in a vacuum, right? So except 9/11, unfortunately, two buildings collapsed in America, and the next day the market was down. That is a very, very rare event. If you look at even COVID, see, sir, COVID was a COVID-19 phenomenon.
Mhm.
When did the market fell? March 2020. It gave you 4-5 months to think about COVID as a risk. You know what I'm saying? September
True.
24, we were debating the market is expensive in June 23. That mid caps and small caps are expensive in June 23. So people were aware of the risk that were emanating. Risk doesn't manifest itself suddenly. So you can plan for the risk management also around the product. But I want to draw one more point. These are theoretical ranges. We don't necessarily have such a wide range. Typically, we'll be in the 40 to 60% kind of a range, net equity exposed. And when things get really sour, we'll bring it down a little, let's say 20%. And when things really become exciting, we'll take it down, take it up to about 75-80. So the range is closer to that. These are the theoretical ranges.
And what is the downside to this fund, equity long short fund, when it can really go bad? When we talked about the fund managers, experience, expertise, fund house expertise, etc. There, if they go wrong on calls, then the
Yeah.
fund can get into risk. Is there any other?
In my experience, I don't think there is a challenge in terms, the downside is reasonably managed because it's managed by a process as well. The challenge that you will face from some time to time is, let us say, when the market went up 42%, we went up 44%, right? But some long only products will do 60% or 70% at that time because they are not hedged. So long only products will do better in those raging bull markets, right?
Okay.
So people will then say, "Arey, I've invested in an equity long short product, but you are only giving 44. My small cap fund is giving me 65. I'm just, making you aware." And vice versa. That if the markets are down, right? The market is down 30%, and let us say we make 6%. Then somebody will say, "Arey, you only made 6% when the market is down 30. You made only 6%. My arbitrage fund has made 8%." You know what I'm saying? So it will get compared on both sides to wrong products, right? On the upside, it will get compared with a very long only product, and the downside will get compared with a fixed income product. So people have to know that this is a very distinct asset class where you are getting an equity return and protecting capital. So the risk return cannot be compared, in a bearish market to a fixed income and a bullish market to an equity product. It has a distinct risk return profile. So I think that is the understanding, that will need to be educated. That's the understanding you need to bring about.
Sure. And there are certain questions like, okay, this one I think I can answer. Where can we watch the status of the fund? What is the minimum period of holding? Minimum suggested holding period is generally 3 to 5 years for this kind of funds. However, the exit load, is almost nil after 6 months, if I am right. So there is no issue about it. And the status of the fund, minimum investment amount is, Kumaran has asked the minimum investment amount. It is 10 lakhs. Then subsequently, if ITI or Divinity brings another fund, there you can invest even 50,000 or 1 lakh. But first minimum into a fund house is minimum 10 lakhs years. And the thing is, where can we watch the status of the fund? Generally, if you are an investor through us, You can watch it in our back office itself, along with the portfolio. Every other mutual fund portfolio, SIF will also come. If not, you get regular statements, and then it should also get reflected in the ECAS NSDL statement that you are getting. So all those things. And if there are no other further questions, probably we will wind up. Probably Ranjan, I will give you a few minutes to explain on the product itself, the NFO period, all the things that the investor looks for.
So thank you, sir. The NFO is opening on coming Monday, that is 10th, and 24th is a closing. And as sir, you rightly said, somebody has put where you say the status. It is available everywhere. Your ECAS statement will do that. It is same like mutual fund unit, mutual fund statement. It will come, and the product will be available BSE, NSE, MFU, all the platform wherever you are doing transaction. Offline also is there. So the the product is a mutual fund product, and thanks to SEBI, they have given us an opportunity to create given a manufacturing opportunity to create something better as a protection of wealth in under mutual fund umbrella. So that's the best thing. So probably the product will become very large segment in coming years. And correct, I would say in my small experience that this product at current market time is a perfect approachment to wealth protection plus creation.
Good, great. And yeah, after 10 lakh, Suresh Kumar has asked, after 10 lakhs, you can add any amount in the same scheme, even in multiples of 5,000, 10,000, 5,000, if I'm right. Yes. Also, you can do SIP, you can take out SWP, everything is available. So minimum redemption is 25,000 rupees. And, but however, always you should maintain 10 lakhs in the portfolio. That is as per SEBI regulation. And probably I wanted to, Ranjan, I wanted to have a call with Rajesh Bhatia for quite some time. Just wanted to pick his brain, understand his, the thought process, everything. Finally, this has given me an opportunity as well as our subscribers as well. It's really great. Rajesh, when you are in Chennai next time, definitely make sure to stop at our place. And,
look forward to it, sir.
Yeah, definitely. And we wish you good luck, Divinity. As the name says, it's a great name. We wish you good luck. And this, whatever you are doing only for the rich people, that's how I will put it. Now you have brought it to the middle class also. So, which is the great transformation in the Indian investment industry. They really appreciate your time. Probably subsequently, if we have any other, probably, we would also be interested in this offering, just because of the fund house and the fund manager's expertise. That is the main thing I am putting trust on. So, probably there is one question. If you want to answer, you can answer. After that, we will close. Expected return. One person is asking. Kumaran is asking what he can expect.
So I can only say that I think what the product has done over a long period of time. So it has done market beating returns, and it has averaged around 15% over 7.5 years. So I think if you are able to deliver anywhere close to that, I think we will be successful. So equity returns, it's linked to the equity markets as well. So it depends upon what the equity markets do. So we will follow similar criteria to the equity markets.
Okay. But I want to add one more thing. If we suggest this product to our investors, our hearts will be normally beating when the market goes down.
No, that is where you hit the nail on the head. Our value addition is only seen when the market goes down, right? See, because when the market goes up, let's say even if we make 44%, there will be equity funds which will be making 60, 80%, right? Because they are taking different type of risk. The value add of a long short fund will only be felt when the market goes down. That is when you see that your capital or your downside is protected. That is the time you will appreciate a long short equity fund. And if I don't protect your downside, there is no reason to invest in a long short equity fund. You know, if my risk return is like a long only, and then why are you in a long short equity product? So capital protection or downside protection is one of the key reasons why you should be looking at a long short equity product.
Great. Thank you for sharing your knowledge, and it is a great conversation. And because we wanted to have this particularly because this is one of the first few equity long short products. We want to give an understanding to the customers and investors across the country, how this works, how this happens. Anyway, thank you for participating, Ranjan. Although you are in Cochin, now you also logged in, and you are ready to chip in case Rajesh could not join. Anyway,
No, sir. Sir, one thing I always tell everyone knows that in Chokalingam sir's YouTube channel is a famous one, and honestly, Rajesh ji, once it is done, you will you look the channel. He puts everything in a simple manner. And by the way, sir, Rajesh ji knows Kunchum Kunchum Tamil also, so he knows that he understands. So that is also there. So thank you. Honestly, sir, thank you for opportunity, and Rajesh ji, thank you for your time, and thank you everyone who has participated, and have a nice weekend to everyone. Thank you, sir.
Rumba thanks, sir.
Rumba thanks. Thank you. Have a great day, great weekend. Thank you, participants. Thank you, subscribers. Probably check with us if you need further details. Thank you all.
Thank you.
Thank you.
Thank you, sir.
Thank you.